When you buy a house in California, you map out every penny. You punch the purchase price, your down payment, and the current interest rate into a calculator to pinpoint exactly what your maximum monthly housing cost will be. State law provides a heavy shield for that monthly budget. Back in 1978, facing massive property tax hikes that pushed people out of their homes, voters passed Proposition 13. This capped standard property taxes, tying them strictly to the home's assessed purchase price and strictly limiting annual increases. But months after closing, the county sends the first actual property tax bill. Right there on the breakdown is an extra, unbudgeted line item that bypasses that calculator entirely, adding hundreds or even thousands of dollars to the annual cost of the home. This is a community facilities district tax. Everyone in California calls it Mello-Roos. The state's most famous tax shield has a massive, legally sanctioned blind spot, allowing local governments to charge a premium that routinely breaks a new homeowner's carefully planned budget. A community facility district, or CFD, is a legally drawn zone within a county or city. When voters within a CFD approve it, the district gains the authority to sell municipal bonds to raise immediate cash. This system was created in 1982 for a very specific reason, because Proposition 13 severely restricted the revenue counties could collect from regular property taxes. Local governments suddenly found themselves without the cash required to build infrastructure for expanding suburbs. This data visualization compares the two distinct tax formulas at play. An ad valorem property tax is calculated using the actual financial value of the home. But a Mello-Roos special assessment is calculated based strictly on physical metrics, dividing the district's total bond debt equally among properties by using square footage, lot size, or frontage area. Because Mello-Roos is disconnected from the property's financial value, Proposition 13 restrictions do not apply to it. The regular ad valorem tax hits a hard legislative ceiling, while the CFD calculation stacks a separate flat fee directly on top of the resident's final bill to pay down the bond debt. Lawmakers left the existing property tax rules completely intact. They simply created a new category of debt that those old rules couldn't touch. So once those bonds are sold and the cash is raised, where does the money actually go? It pays for the heavy infrastructure required to make raw land livable. We're talking about pouring new concrete, grading roads, laying sewer lines, and building highway overpasses. It also finances the brick-and-mortar construction of essential local institutions, paying the immediate capital costs to open brand-new neighborhood schools, and it funds the ongoing community amenities that draw buyers to a neighborhood in the first place, like landscaped public parks, enhanced police services, and even local hospitals. Buyers pay a premium, but they are actively financing the physical creation and maintenance of their own immediate surroundings. The debt for those improvements, however, stays tethered to the property for decades. Mello-Roos special assessments typically last 20 to 25 years, and state law allows them to stretch up to 40 years before the original bonds are fully paid off. And the cost doesn't stay flat. The law allows CFDs to increase the assessment by up to 2% every single year to account for inflation and administrative costs. The true financial weight of this system only becomes clear when homeowners sit down to file their annual income taxes. The IRS strictly limits deductible property taxes to those based on the assessed value of the real property. Because Mello-Roos is assessed using physical metrics to bypass Proposition 13, it does not qualify. The fees are not tax-deductible on federal returns. The financial sting hits the homeowner twice. They pay an inescapable premium on their local property tax bill all year, and the federal government denies them any deduction for it in April. Mello-Roos is an expensive, relentless premium, yet by guaranteeing high-quality infrastructure and well-funded local services, it often helps protect and maintain the long-term investment value of the home itself. The danger lies in the real estate market's historical lack of transparency. Sellers and agents are required to disclose Mello-Roos costs, but they don't always explicitly advertise a property's CFD status up front. The burden of proof falls entirely on the buyer. Before making an offer, you have to look up the parcel number with the county recorder and pull the property's prior itemized tax bills to see exactly what special assessments are hiding in the margins. Ignoring this fee carries severe consequences. If the assessment goes unpaid, the community facility district itself holds the legal authority to file a judicial foreclosure and force the sale of the property. Think of Mello-Roos as the mandatory hidden subscription fee for your neighborhood survival. Your only defense is verifying that you can actually afford the subscription before you sign the deed.